right, good morning. It is Monday, June the 1st. Welcome to June 2026. We hope everyone had a nice weekend. I finally got around to doing some much needed yard work, like the trimming of some bushes and some trees and things. Trying to have my kids help out a little bit. Mixed results from their effort, but really nice to get that done. And then I got the yard mowed right before it started raining hard yesterday afternoon. So that was a success. Hope you enjoyed your weekends as well. Last week in markets, a holiday shortened week with Memorial Day, of course, Monday, and ninth straight week higher in U.S. equity markets. So a really strong month of May. Yeah, again, this is just kind of some of those calendar sayings. Like, this is a good example when they don't work. The old sell in May, like go away. I think it's something like that. Like, that would have been a mistake this May for 2026. But we've been talking about earnings a lot, being the primary driver, just how strong earnings were in this most recent quarter. But I as I was kind of reviewing our portfolios that we manage, I noticed something kind of interesting that I thought was worth sharing. And just looking at emerging markets. Okay, we don't talk about emerging markets a lot just because they are quite volatile. And in the portfolios we manage, all right, like of like the entire international piece, like emerging markets is just going to be like a fraction of the international piece because it is so volatile. But you do want to own them because the potential return can be quite high at times, as has been the case here in 2026. And you hear us talk a lot about diversification, just like broad international diversification. It makes you own everything. But I want to take like one step further. Just like why it's important to even diversify your emerging market holdings. Okay, so if you just kind of look at the broad benchmark for emerging markets this year, so far year to date, so the first 5 months of 2026, like emerging markets, like a core kind of index fund, up about 25% this year. All right, so that's if you have diversified fund. Just looking at some of like some of the portfolios that we manage here, 25 emerging markets value, right? So a tilt to value is about 28% this year. So right in line with that 25% benchmark, maybe a touch better. But what's interesting, so I have on my screen right above here, like the largest emerging market economies and how each of these independent markets has performed so far this year. All right, and while I think it's, if you want to overweight a certain country with just owning like a particular ETF, like you can certainly do that, but buyer beware. Like, you have to go in knowing how volatile things can be, right? So again, keep in mind, 25% is the average, like the average weighted return in emerging markets this year. Now let me read so far year-to-date returns in some of these individual countries. Brazil, plus 13%, China, minus 8%, India, minus 11%, Indonesia, minus 35%, Korea, plus 118%, Mexico, plus 15%, Taiwan, plus 60%. So you literally, you have some countries that are up over 100% and plenty that are negative, like a good bit negative. Indonesia minus 35, for example. So just kind of goes to show, like, while most investors in the US, like your emerging market holdings are going to be relatively small, just the case why you probably want to diversify those holdings and not hold, it just I guess more so trying to highlight the risks of owning individual, like very country specific ETFs for that emerging market exposure. So I just thought that was interesting, just to kind of show just the variance of returns just in emerging markets. So bringing it back home, domestic, again, like I mentioned, another week higher, 9 straight weeks higher in the U.S. equity markets. Last week's inflation data did confirm some concerns from the previous week's CPI. All right, so last week's inflation data, PCE, which is the Fed's preferred inflation metric, up 3.8% year over year. And like, I wish I could say it was just oil, right? Just given Iran and like maybe it's just the price of oil, but yeah, they have a metric. They exclude food and energy out of one of the readings called core PCE, and that was 3.3%. So like even excluding energy, oil, 3.3%, still well north of that 2% target, which probably means interest rate cuts are off the table, at least in the near term, it seems. We'll see. Markets even pricing, later out, potentially needing to raise rates a little bit, not a lot. We'll see. Base case is probably no interest rate changes at all for the rest of the year. But this week, as is usually the case, the first week of the month, we're going to get a lot of employment data, a lot of jobs data kind of coming through. The biggest report that people spend a lot of time looking at will be the Friday jobs report. We'll see how things shook out in May and if there were revisions for April. So outside of that, questions, comments, concerns, please don't hesitate to reach out to our team. And we hope you have a great week. Thanks.